Hey folks, today we're going to talk about Annuities 101. Now, I teach seminars on a regular basis, and I'll have anywhere from 15 to 50 people in the room. And I always make it a point when it comes to this subject to walk around the room and go from person to person to person and ask them these two questions. The first question is, what is a CD? And they struggle with that. They say, well, a CD is a certificate of deposit with a banking institution. It's a set rate for a set amount of time. If I pull it out early, there's a penalty. And they got everything about that right except for it's a certificate of disappointment. Now, I'm joking. All right. So then I walk around and I ask each and every person, what is an annuity? And over and over and over again, I hear anything but the correct answer. Now, this chart will show you that annuity is a definition, is an agreement between you and another party where money is deposited and later returned in a series of payments. The three common forms of annuity are public annuities or Social Security, private annuities or pensions, and asset-backed annuities or insurance companies. Now, it's important for you to understand that this is kind of the right description, but it really isn't. At the end of the day, when we're talking about annuities, we all know what Social Security is, we all know what a pension is, and we pretty much all know that that is an annuity. But when we're talking about on the investment side of the house, and we're talking about an annuity or asset-backed annuities with an insurance company, really all an annuity is a savings account with an insurance company. Now, who's got more money, banks or insurance companies? And the answer is insurance companies, hands down. Who bailed out the banks and the government during the Great Depression? Insurance companies. Hey, how about this one? Where do banks keep 25% of all their tier 1 liquid assets? And the answer is in insurance companies. So let's take a look here at how these annuities work. All right, they're this asset-backed annuity characteristic. It can be held in either tank. It can be in the investment tank, or what we call the yellow tank or the risk tank, and it can be held in the safe tank, or what we call the green tank. So we don't have to be taking risk with the annuity, but we can take risk if we choose to. You decide how much to contribute and when. Then the account grows depending upon the type of annuity. Then in addition to that, if we choose to turn it on for income, that banking institution or that insurance company will give us a stream of income that no matter how long we live, that income will keep coming. And even if we run out of money in our account, the income will keep coming. So here's a question for you. If you could be rich or 100% guaranteed you never run out of income, which one would you choose? Now, knowing full well that in order to retire, you must have one thing, which is a paycheck. Do you want a paycheck that's going to run out? Or do you want a paycheck that's going to keep coming and coming no matter what happens? So basically, one of the best uses for annuities in today's marketplace is to use an annuity to create a pension so that you don't run out of money. Now, there are different types of annuities. There are fixed annuities. Now, a fixed annuity is very, very much like a CD. The only difference is when we put money in a CD, if we just put in after-tax money in a CD, we get a 1099 at the end of the year. Whereas when we put it in a fixed annuity, there is no 1099 at the end of the year. It continues to grow tax deferred until we take it out. And it grows at a fixed rate for a fixed period of time. And just like a CD, if we take it out early, there's a penalty. Now, frequently, the annuities are going to be a little bit longer, 3, 5, possibly even 10 years on a fixed. Generally, we wouldn't use longer than 3 to 5 on a fixed. And then there's something called an indexed annuity. Now, an indexed annuity, it participates in the gains of the market, but it never participates in the losses. So when the market goes up, it gets a certain amount of growth, but when the market goes down, it gets no losses at all. Now, this sits over in the safe tank, and its income is based on limited market participation. So when the market's going up, this is a chart, looks very much like 2000 through 2013. We can see in 2000, 2001, 2002, the market went down, we went sideways. Then we went up for 5 years, and then 2008, the market dropped, and we went sideways. And then the market went up, 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 and then we had one small drop there, and then we continued to get those gains. This is a very good way of removing the risk, but yet still getting pretty good gains in the market because we have index floors, caps, spreads, and drive growth. Depending on selected rider fees are optional if we want to use it for income going forward. Now, there are plenty of annuities out there today that we can get index growth with no fees and grow our money at pretty substantial growth rates. As a matter of fact, better than most people do in the market. Now, the next choice is what's called the variable annuity. And quite frankly, I would never buy a variable annuity, but it is an option that's out there. Now, a variable annuity always sits in the risk tank, and that means it's going to go up and down with the market. And one of the problems with a variable annuity, despite some of the promises they'll give you and guarantees they'll give you, is that it still has very high fees in it, but it does get all the gains of the market and all of the losses. So when the market goes up, it goes up. When the market goes down, it goes down. Now, what they'll do is give you guarantees and say that if you die, you'll have this number. And if you live, you'll have a guaranteed number as far as income goes. You can still pretty much outperform that inside of an indexed annuity about 99% of the time. You get to select your investment accounts of the choices that are inside of there. Fees are part of the contract. Careful, they're generally very high and fairly well hidden inside of there. Depending on selected riders, and additional fees are optional, and so you could use it just for growth or possibly for income going forward. Now, some key takeaways to remember about annuities. The first one is liquidity provision. Varies based on annuities. For most annuities, not all, you have a 10% per year, 1 year after contract. You can take 10% out of the annuity without any penalties. Be careful, it might be just on principal, it might be on the account value. It's backed by a large insurance company, not a banking institution. The account growth should be considered. So do I want a level, steady growth, or do I want to get the gains of the market, not participate in losses, or do I want to go all out and go after all the gains? It's designed to provide a lifetime income. So if I choose to use it as an income, when it runs out of money, it doesn't run out of income. Now, folks, this is just a very brief overlay of how an annuity works. If you want to know really how annuity works, how caps rates, how spreads, and how all that works, we have a course out there, and you can go down below down here for a nominal cost. You can get that course and truly learn how these products work and whether they would work for you or not. Remember to live like you die tomorrow and plan like you to live forever. Be sure to subscribe to our channel here and put some comments in about your thoughts on annuities. Be sure to go check out that course and make it a great day and keep smiling.